T24 Financial Forecast, Mastering Personal Finance amid Bank of Canada's interest rate fluctuations. Welcome to Forum Finanzia, your go-to channel for personal finance in Canada. Today, we're unpacking the Bank of Canada's interest rate fluctuations and their impact on your finances in 2024. Whether you're juggling mortgages, investments, or just trying to make sense of it all, this is for you. Today, everyone's talking about rates decreasing. Are they? So let's try to create a compass. Hopefully, we can provide some insight and guidance on how to navigate the possibilities of the coming year. Will the Bank of Canada lower its policy rate as economists predict? Or will rates hold steady, or even climb higher? Each scenario presents unique challenges and opportunities for Canadian households. Understanding the Bank of Canada's policy rate. Let's talk about the Bank of Canada's policy rate. This rate is like the thermostat of our economy. When the bank cranks it up, it's like cooling down an overheated room. It slows down spending and keeps inflation from running wild. On the flip side, when the bank drops the rate, it's like adding fuel to the fire, spurring people to spend and invest more. For us Canadians, this means our loans and mortgages could get cheaper or pricier depending on what the bank decides. It's a delicate balance, so keep an eye on those rates. They're steering the ship of our economic journey, and you don't want to be caught off guard. Behind the recent increases. In 2022, the Bank of Canada escalated the policy rate significantly to counter rising inflation, which had been persistently above the target range. This inflation surge was influenced by various factors, including supply chain disruptions, recovering demand post-pandemic, and global economic pressures. The increased rate aimed to temper these inflationary pressures by cooling down overheated market sectors, particularly the housing market. Potential for a decrease in 2024. As we look to 2024, there's speculation about a potential reduction in the policy rate. This speculation stems from a belief that the measures taken have begun to control inflation and that a reduced rate could foster economic growth in a stabilizing environment. However, such decisions will depend on ongoing economic assessments. So don't believe for a second that speculation is factual. It may come to be, but it's not a certain. Economic indicators influencing rate decisions. Several key indicators guide the Bank of Canada's rate decisions. These include inflation rates. The primary target for the bank is to keep inflation around 2%. We are not there yet. GDP growth, indicative of the overall economic health. Need to watch this one. Employment rates. High employment can increase inflationary pressure. Need to watch this one even more. Global economic trends. International trade and economic policies impact Canada's economy. And obvious. Consumer spending, a reflection of the public's financial confidence and economic activity. So far, still ongoing. Preparing for a decline in interest rates. All right, let's say the Bank of Canada decides to take a little pressure off the gas pedal and lower those interest rates. What's the game plan? It's time to make some smart moves. If you've got a mortgage, now's the time to look into refinancing. You could end up with lower monthly payments or maybe pay off that home loan faster than you thought. And for those of you sitting on some cash, with lower rates, borrowing for investments or big purchases won't hit your wallet as hard. But remember, you've got to be careful. Don't go splurging on things you don't need. Instead, focus on investments that can grow over time. And don't forget to beef up that emergency fund because life is full of surprises. Positive impacts on mortgages and loans. Refinancing mortgages. Existing homeowners might find refinancing their mortgage beneficial. With lower rates, the potential to reduce monthly payments or shorten the term of the mortgage can lead to significant long-term savings. Negotiating for new loans. For potential buyers or those seeking loans, it's an opportune time to secure lower interest rates. Strategies for homeowners and potential buyers. Evaluate mortgage options. Fixed-rate mortgages become more attractive in a falling rate environment as they offer stability. However, variable rate mortgages could still be a cost-effective option if rates are expected to drop further. Consider home equity. Homeowners can consider tapping into their home equity for debt consolidation or other financial needs, as home equity lines of credit, HELOC, might have lower interest rates. Investment opportunities with lower interest rates. Real estate investments. The real estate market often becomes more attractive due to lower financing costs. Stock market. Certain sectors in the stock market tend to benefit from lower rates, such as consumer discretionary and real estate. Bonds and fixed income securities. There's a potential for bonds to increase in value when interest rates fall. Implications for savings and emergency funds. Rethink savings strategy. Traditional savings accounts and fixed income investments might yield lower returns in a low-rate environment. Exploring alternative savings instruments or higher-yield accounts could be more beneficial. Emergency funds. The value of having an emergency fund becomes even more critical. In a lower interest rate environment, ensuring that these funds are easily accessible, yet still earning some return is important. When the Bank of Canada decides to lower the interest rates, it opens up a whole track of opportunities. For you homeowners and those looking to buy, it's prime time to look at your mortgage options. And for the savvy investors out there, dive into the diverse investment pool. But keep your wits about you. And hey, don't ignore your piggy bank. Reassess and beef up those savings strategies. We're talking about a golden window of opportunity here for those ready to roll up their sleeves and make some smart, informed choices. This is your chance to build that financial fortress one brick at a time, navigating steady interest rates. So let's say the Bank of Canada decides to keep the interest rates steady. What's your move? Well, it's not the time to sit back and relax. Keep an eye on those mortgages and loans. Stable rates mean your payments aren't going down, but they're not shooting up either. No surprises, but you've got to keep working at it. Stick to your budget like it's your favorite restaurant, knowing exactly what you'll get. And hey, don't let those investments drift. Keep steering them with a steady hand. It's all about balance. A stable rate means you've got a clear path. So keep walking it with your eyes wide open and your finances in check. Implications for ongoing mortgages and loans. Refinancing decisions. For those considering refinancing, stable rates mean less urgency but still an opportunity to find better terms if they haven't already locked in a low rate. Long-term planning. Borrowers with ongoing mortgages can plan their finances with more certainty, knowing their mortgage payments will remain constant. Managing financial commitments. Debt prioritization. Prioritize high-interest debts, such as credit card balances, as they won't benefit from rate decreases. Consolidation options. Explore debt consolidation options if you have multiple high-interest debts, as this can simplify payments and potentially lower overall interest. Budgeting and financial planning. Robust budgeting. Develop and adhere to a budget that accounts for all expenses, savings, and debt repayments. Emergency fund. Ensure you have a robust emergency fund, typically 3 to 6 months' worth of expenses, to safeguard against unforeseen financial disruptions. Investment strategies for stability. Diversified portfolio. Maintain a diversified investment portfolio to mitigate risks and capitalize on different market conditions. Income-generating investments. Consider investments that provide a steady income, such as dividend-paying stocks or bonds. Risk assessment. Regularly assess your investment risk tolerance, ensuring it aligns with your financial goals and the current economic environment. All right, let's sum this up. Steady interest rates are not flashy, but they get the job done. Sure, you're not getting a big break on your loans, but there's no roller coaster ride either. It's all about keeping your financial house in order. You've got to manage those debts like a pro, keeping them in line and making sure they don't get out of hand. Stick to your budget, discipline, no frills, just results. And when it comes to investments, play it smart. This kind of stability, it's gold for laying down a solid financial foundation. It's your launch pad for those big dreams. Stay steady, stay smart, and build that financial future with confidence. Bracing for an increase in interest rates. All right, let's talk about a scenario where those number crunchers at the Bank of Canada throw us a curveball, and those interest rates start climbing instead of coming back down. First things first, don't panic. Stay calm and plan your way forward. If you've got a mortgage or a loan, think about a short and long-term course of action. This might mean locking in a fixed-rate mortgage before the rates climb higher. And if you've been juggling some debts, now's the time to get them under control. Focus on the high-interest ones first. For your investments, keep an eye on those stocks and bonds. Some might not do as well with higher rates, so be ready to adapt your portfolio. And hey, don't let your emergency fund run dry. In times like these, it's your safety net. Stay sharp, stay informed, and remember, even when the financial winds change, there's always a way to steer your ship through the storm. Impact on mortgages and loans. Variable rate mortgages. Those with variable rate mortgages will see an immediate increase in their monthly payments. It's crucial to assess if your budget can handle this increase. New borrowers. Higher rates mean more expensive loans. If you're considering taking on a new mortgage, expect higher monthly payments. Debt management and emergency planning. Refinancing and locking rates. If you have a variable rate mortgage or loan, Consider refinancing to a fixed-rate option to avoid further rate hikes. Emergency fund. Bolster your emergency fund to cover increased loan costs or unexpected financial setbacks. Aim for an emergency fund that covers at least 6 months of expenses. Safeguarding investments. Rebalance portfolio. Review and rebalance your investment portfolio to align with the changing economic landscape. This may involve shifting to assets that traditionally perform better in a high-rate environment. Fixed income investments. Be cautious with long-term fixed income investments, as they tend to decrease in value when interest rates rise. Adjusting household budgets and savings plans. Review and cut expenses. Scrutinize your monthly expenses and identify areas for cost cutting. This might involve reducing discretionary spending. Increase savings. Allocate a larger portion of your income to savings to cushion against the impact of rising rates, especially if you have a variable rate loan or mortgage. Gearing up for a hike in interest rates requires a comprehensive. You've got to tackle your debts head on. Cut down those high-interest ones first. Then there's your emergency fund. That's your first aid kit. Keep it stocked. In the investing game, be ready to switch gears. Your portfolio might need a tweak or two when the financial weather changes. And let's not forget the cornerstone of it all, your budget. That's your map and compass keeping you on track. By taking these proactive steps, you'll be ready for whatever the economy throws your way. Final thoughts and actionable tips. Well, as you can see, I don't want you only preparing for interest rate declines. Yes, I know we would all like that. But that's not a realistic way of approaching personal finance. Whether those rates decide to dive, stay steady, or climb higher, the key is to stay prepared and adapt. It's like being ready for any weather when you're planning an outdoor adventure. Whether it's sunshine or a snowstorm, you've got to have the right gear. Remember, managing your finances in these times takes attention and a bit of finesse. Keep an eye on those mortgages and loans. Shuffle your investments to match the economic climate, and always have that emergency fund ready. In the end, it's all about being as resourceful and resilient as possible. Stay informed, stay agile, and remember, every financial challenge is just an opportunity in disguise. It's your journey, adjust your compass, and let's move forward with confidence. Thank you for joining us on Forum Finanzia. If you found this guide helpful, hit like, subscribe, and share with your friends. Stay tuned for more insights into mastering your personal finances. Until next time, keep making smart financial moves, Canada.